So once again, welcome all of you, and we'll start this session. And I see a lot of people have joined, and I think more people are joining. But we'll start this session and continue. Please, if you miss anything on this, the recording of this session will be put on YouTube. So you can always go subscribe our channel and even look at our previous sessions, because webinar is something which we do every week on a very different topic, and the purpose is very simple: to keep the clients informed, to keep the investors informed about what's going on in the financial markets. Needless to say, whatever we are going to discuss today, it's mostly for information purposes. So please do not take any of the strategies we discuss here. Please do not take it as advice or recommendations. It's only for information purposes. If you want to invest anywhere and if you have any questions, please talk to our risk experts. We can have a one-on-one sessions after these webinars. You can book your time slots, and we are more than happy to welcome you in our office and talk more about what we are about to discuss today. So with this, let's start and understand today's topic, which is understanding from economic data going beyond charts. A lot of traders, I'm sure, and a lot of investors have always talked about that how they don't understand technical charts and patterns, and they always have this question: how important are the charts? Do I need to be a technical analyst to understand charts and then trade? And the answer is absolutely no. If you have any of these myths, let me clear it right away. You don't have to be a technical expert. You don't need a certification. Obviously, if you have a certification, that works in your favor, but doesn't mean that if you don't have a certification, you're not eligible for investment. Investment is something which is your right, and you should know where to invest, where is your money going. And as far as information or knowledge is concerned, you can always gain more and more knowledge. In terms of investment decisions, your decisions are based on two facts. One is charts, technical analysis, what we call it, basically taking your investment decision on the basis of historic pricing. So for example, if you see any stock like Facebook, it comes down to 200 every single time and bounce back from there. This is technical analysis. It's just charts. There is no reason, there is no information which will make you buy Facebook due to any sort of fundamental reasons. It's just that you have seen back in last 2 years that every time Facebook comes down to $200, you end up buying that. That's called technical analysis. However, investments is more than just charts. And traders who want to take long-term positions, they always want to analyze the economic data. They always want to check which is the economic event which is going on. And today we are going to discuss these events. We're also going to discuss how these events actually impact your investment decision and even the prices. So think about, we're also going to go through our live platform, Century Traders, where I will show you the actual impact before a news came out and the impact after the news came out. And I'm going to show this right away after a few slides once we discuss that what are the important news which we should see. Now, economic events are segregated into different kind of indicators. Now, what you see right now are few very important news which we should always keep a check on. But when we talk about economic indicators, we are looking at different kinds of economic indicators. Now, there are leading, there are lagging, and then coincident. Just to make it very simple, we are talking about leading indicators which actually show you that there are some changes which are about to hit an economy. So let's say, for example, if recession is about to come, the leading indicators will start reacting before it happens. So it tells you that this is about to happen. And as the changes happen, as the economy gets progressed or it starts deteriorating, you see that those indicators try to predict that. So these are leading indicators, right? Then there are lagging indicators. Now, lagging indicators, as the word suggests, when the economy already gets affected, then you get to know. Like, for example, the moment recession starts hitting in, you will see the unemployment rate, it starts increasing. Now, unemployment rate does not start increasing before the recession hits. It happens after the recession hits. So it's a lagging indicator. While if we talk about a leading indicator, we are talking about something which is related to share prices or business formations or a GDP, for example. It's a leading indicator. Similarly, there are coincident indicators also. Now, those are the ones which are, as the economy changes, these indicators parallelly show their impact. So, GDP, as I said, is a leading indicator, but it can also be a coincident indicator. Whichever the direction economy moves to, GDP moves into that sort of a direction, and it is considered a coincident economic indicator because it moves parallelly with the economy. So we are going to look at all these economic indicators. We are going to look into GDP. We are going to look into unemployment rate. We are going to look into FOMC meeting, inflation data, which is called by consumer price index, and then obviously there is a manufacturing and services data. If you understand all of these news and the impact what it creates as an investor, if you have to take any long term investment decision, these kind of news will definitely help you out. And if we talk about FOMC meeting and CPI and GDP, these are very, very important economic indicators. And I will show you live on the platform that how these economic indicators, how these news actually impacts the prices of commodities, they impact the prices of stocks, and they also impact the prices of a lot of stock indices. So currently, wherever you have invested, it is being impacted by these important economic news. So start with FOMC. Uh, this you will hear a lot, but currently inflation is on its peak, right? Meanwhile, guys, I am sure because there are so many people right now. So if you please can start writing. If you have any questions, please do write any questions. And meanwhile, if you can see my presentation, if you can hear my audio real quick, please drop me a yes or a okay using your chat option, so that it will be easy for me to proceed. Just try using a chat option. Send me a yes or a okay if you can hear me properly, if you can see my presentation, or if there is any sort of congestion in the network, please notify this. And if you have any questions also, you can write it right away. All right. Okay. Okay. I see a lot of yeses, lot of okays. Perfect. Perfect. Great. Great. So I'm assuming everybody can hear this. Perfect. Okay. Perfect. Okay. Okay. Great. So I got a lot of yeses. So I'm just going to proceed with it. Just in case if you have any glitches or if you feel you have missed out a part, please go back to Century's YouTube channel, subscribe it, and you'll be able to see the presentation as well. Now, inflation, I'm sure a lot of you must have heard about. It's nothing else. When things start getting expensive, you see that inflation is hitting really hard. So basically, your currency gets weaker, and due to that, everything around you starts getting expensive. Inflation, whether it is good or bad, it's always be a debate, because it's not too much inflation is not good, too much inflation is too less inflation is also not good. And that's why inflation needs to be targeted. There is a specific number which central banks they aim for. Can anybody tell me that number? Can anybody guess that number? There's a, and I'll give you a hint. It's a percentage basically, and I'll give you a chance. If you want, you can Google it. What's the inflation target for US or for Europe or for the central banks, and then give me an answer. Just check. We can make this more interactive. So my question to you is, what do you think the inflation target is for a lot of central banks? Say Central Bank of US. What do you think the inflation target is? At what rate it is acceptable to the central bank that the price could increase? Okay, I think a lot of you have started Googling here, and I think I've started getting my answers. Okay, 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 okay. Perfect, perfect, perfect. Great, great. I think a lot of you have given one common answer, which is somewhere around 2%. Somebody said around 2%. Somebody said 2%. Someone said 5%. 5% is not by US. 2% is the right answer. So everybody who said 2%, absolutely. So 2% is what US central bank targets, and most of central banks they target a 2% inflation. And the reason is very simple. Uh, if there is inflation, People spend more, they spend more, the manufacturing and the production increases, the supply of cash is enough, and the demand increases, and that's why inflation is needed. But the moment inflation starts increasing too much, now that's a problem, because if inflation is too high, and if the economy is not doing well, then there is a problem in the employment. People start losing their jobs, everything becomes too expensive. So anybody who is not under the high income group, they start missing out on being able to purchase a lot of things. Like, for example, something which is expensive for you today may not be expensive for someone else. And when the inflation goes up, a lot of high privileged people would be able to buy the same thing, but low privileged cannot. And that impacts the economy because the quantity of low privileged people is higher. So that's why high inflation is not that good either. Now, what central banks do, uh, the central bank of US, as you can see this chart, we will take example of central bank of US over here. Central bank of US is called Federal Reserve. And Federal Reserve created one specific division, which is called Federal Open Market Committee. And to show you here, Federal Open Market Committee is what people call as FOMC. It's nothing else, it's just a division in central bank of US which is being created to talk about how the inflation will be controlled. So central bank of US, when they see that inflation is going higher, to control the rate of inflation, what they have to do is they have to decrease the supply of money. And to decrease the supply of money, they have to make loans more expensive, because if loans are more expensive, people will borrow less. If people will borrow less, then they will spend less. If they spend less, then the supply of cash in the economy reduces. Now the supply of cash in the economy reduces, the value of dollar becomes stronger, which controls the inflation, because inflation means that the value of dollar is weaker. Similarly, when inflation is too low, like right now what is going on in China, the inflation is too low. So what they're trying to do, they're trying to inject more cash in the economy to increase the supply. Because if supply of money increases, then people tend to spend more, and the value of the dollar starts depreciating, which means the things start getting expensive. So both the things, too low inflation is bad, too high inflation is bad, and that's why inflation needs to be targeted. Now, this inflation target is done by FOMC, which is a division of Federal Reserve, and FOMC meets 8 times in a year. Please note this down if you have a piece of paper with you. It's not something, it's not a very rare information. If you Google it, you can find it. But just while we are in the middle of the session, it will really help you to understand this. Because why FOMC meeting is really important, because FOMC meets 8 times in a year, followed by a press conference. And that's where things really start getting interesting for investors and traders. Because whatever central bank is going to decide, it's going to decide the future course of stocks, commodities, currencies, indices, and a lot. One FOMC meeting impacts US dollar, it impacts gold, it impacts NASDAQ, Dow Jones, all the US indices, and across the world. If you see, UAE also follows very closely the interest rates in US. So if central bank of US increase interest rates, UAE also increase interest rates, because dollar and dirhams are pegged. So that's the significance of FOMC meeting, and that's why it is in the topmost 5 economic events. FOMC meeting, guys, is really important. The next one, which is the central bank meeting, next FOMC meeting will be around September, around 19th and 20th of September. And this is going to be very, very important, because in last 2 years, central bank of US has increased interest rates up to 5%. Now, because of high interest rates, a lot of investors have found that if we loan money to the US government, we will receive interest rate around 5%. So people started investing money into bonds, and they started taking money out of technology companies, mostly tech companies, because tech companies do not give any dividends and they are really volatile. So it was not worth taking the risk. Let me show you right away what has happened with the tech. I'll take you live to our platform, And this is our own platform where you'll be able to see the live pricing. I hope everybody can see this. Please tell me if you want me to increase the size of my screen or if you can see this clearly. I'm just taking a majority vote if majority of you can see this, because I have around 60-65 people here. So if most of you can see this, I will not increase the resolution. If you want, I can increase this also. Because what I'm going to show you right now is mostly going to be the movement of the tech companies throughout 2021 and 2022 when inflation was at its peak around 9%. Imagine the target is 2% and the inflation is 9%. What would happen to your investments? And let me show you, while for 2 years it was around 9%, what happened to the stocks? Let me show you right there. And I will take tech stocks first because tech was the main sector which got hit a lot due to high inflation. And this is one important thing why you need to look at fundamental of an economy, because in a high, always remember this, note it down, in a high pressure, high interest rate environment, tech stocks are the first one to go down. So let me show you a chart of Amazon, for example, here. And if you and just look at this is nothing else but a price movement. All right, so on your right side you are seeing the prices, and on the left side horizontal you're looking at the dates. Let me just make this, I'll go 2021 and 2022. So if you see this line right here, if you see right here, look at this. This was in 2021 November, where Amazon was $3,600. And once the news of high inflation came out, it went all the way down to 2,800, slowly recovered. But in the beginning of 2022, when the news came out that inflation is near to 9%, just look at this fall. It happened in April 2022, and between April to May, we saw Amazon coming down from $3,300 all the way to 2,100. And this happened in 1 month, from $3,300 all the way to 2,100. And this is just Amazon. Let me show you what happened to NASDAQ, which is a tech heavy index. So a lot of my clients who want to take exposure and take tech stocks, what they do is they buy the NASDAQ index, because NASDAQ has 100, around 100 biotech and technology companies, and you get a exposure in technology sector, but much more safer than investing into an individual stock. Now let me show you where was NASDAQ throughout this time. So 2022, look at this fall, and this is the same fall which I showed you in Amazon. Look at this. It was around 16,500 in December 2021, and by April it went down all the way to 11,000. So from 16,000 to 11,000. And now look at this. While the central bank increased the interest rates and inflation starts coming down, now the current inflation rate is 4%, and look where NASDAQ has, from 10,000 it has gone all the way to 15,800, just like this. And it happened between 1st of May 2023 all the way to July. May, June, July, 3 months. If you had bought NASDAQ at $10,000, in 3 months it would be around 15,000. Obviously, this is a lot of volatility which we can see here, but understand the impact of a news such big as FOMC. That is why we are here to understand that technical charts, just the charts or the knowledge about charts, can let you do a day trade. But if you're talking about a long investment decision, obviously you have to look into the fundamentals, right? So if you see right now, look at this fall, such a beautiful chart. Look at this U-shaped recovery, the fall and rise of NASDAQ. Before 2023, the inflation was high, and look at these on your left side. If you see, there is a big fall because of a high inflation, and the moment central bank increased the rates, you see the sentiment in the market is so positive that the markets have started going up. So this is one thing which you need to know about FOMC meetings, right? And I will show you different news and how they actually impact, because central bank can increase the supply of money through different ways. As I said, interest rates, which happens, they can increase or decrease the interest rates. They can also print more currency, or they just buy government bonds. When they buy government bonds, they basically are loaning money to the government, which government can use for, again, public expenditure. So that is called open market operation. And that's why the Federal Open Market Committee has been created to take decisions on interest rates. So FOMC meet 8 times in a year, and that is why, as I said, the next meeting is going to be around 19th and 20th of September. Do not miss it out. It's one of the most significant event which can happen to your portfolio, right? So, and I will also show you the impact of FOMC meetings later on, but let's cover all the news. Let's cover all the important economic data. I'll also tell you how you can trade or how you can invest in the earnings season. It's one of the most significant and one of the most best months to trade in stocks. So I'm going to also take you through how you can do this. Moving on to another news, as I said, which is gross domestic product, the GDP. And the GDP of any economy, if you see the GDP of any economy, this is one of the most important data because it's a coincidental indicator. And GDP refers basically, in economic terms, if to put it in the most simpler way, the monetary value, the money value or the dollar value, if I can say, of any goods or services which has produced in a economy throughout a period of time, let's say 1 year, for example. So if I'm looking at a year-on-year GDP, I'm basically looking at the monetary value of every good and services which is produced in my economy in 1 year. So if I say that, and GDP mostly is measured in dollars, billions and trillions of dollars. So if I say India GDP, for example, the Indian GDP is $3.1 trillion in 2021. If I say basically in 2023, India is expected to reach around $3.6 billion by the end of 2023. So this is something which is really, really important. Why? Because the GDP of a country tells that how big it is. Like US GDP, for example, 2023, it is expected to be around 2.5 trillion. If I, let's say, for example, 26, sorry, not 2.5, $26 trillion. Now, $26 trillion is basically the monetary value of all the goods and services which are produced within US, right? So this is a very important data because the GDP data comes out quarter on quarter, month on month, year on year, because they want to see that how GDP is progressing. Because if the monetary value of all the goods and services which are produced, if it increases, which means there is a more and more production, people are doing more manufacturing, consumers are buying more, producers are selling more, manufacturing has increased, education is good, services are being produced. And if GDP increases quarter on quarter, year on year, and economy grows year on year at a faster growth rate, it is said to be a positive sign for the company, for the country. And if the growth rate is slow, then it is seen to be a concerned sign for a country. So GDP, if we cannot say that GDP will go negative and then country is in recession. If GDP goes negative, which means there is no monetary value being produced, it's a very absurd thing to think about. It's just if the economy was growing at say 6% year on year, and now it is growing 4% year on year, that means there is something wrong. So the central bank will take measures to do something about it. So GDP is a very, very important data. And I'll tell you where you can see all these important news as well. Because GDP numbers, when they come out, they come with an expectation that, let's say, US GDP is expected to grow by, say, 3% or 2%. And if it grows by 1.9, then the stock markets would fall down because the growth rate of a country has slowed down. So these kind of news impact stocks, commodities in a much, much bigger manner, right? And we have to understand about GDP and we have to understand the significance of it, followed by inflation. So we just had a very big chat about inflation, right? And how central bank plays a really, really important role. But how central bank actually know that inflation has increased? because this is really important, right? Central bank would want to know that inflation is high or low. So how do the central bank knows, or how anybody of us, how do we know that inflation has gone up? We know because we look at something called a consumer price index, the CPI data. And it's one of the most important news because the CPI data will tell us about inflation. And it's really, really important in these times, because inflation was around 9% over a year ago, and now it has been controlled. So we have to understand that what is the significance of CPI to the inflation. It's one of the best measures, and it basically tells you that what is the consumer's intent. Are they purchasing more, or the prices of something which is going really high? Is it a really good indicator? Because it's the most well known indicator of inflation. And this basically measures the change in the price of a basket of goods and services which are consumed by you as a household. So whenever you're looking at the inflation report, you have to see, and it is measured in percentages. So for example, whatever is the percentage change in the prices of goods and services, you will be able to see that in the inflation data. I'll take you to the live market calendar where you can see the news, and I will tell you also how you can see this news. Just let me switch my screen right here. Right. So let's say, let me show you a market calendar. So you can find the market calendar anywhere on any website. We have a platform which can also show you the market calendar. So I'm just sharing that with you. So market calendar is something which is again a really important thing. It's like a bread and butter for a trader and an investor. So currently, if you see, today's 29th August, and first and foremost, whenever you see a market calendar, I'll explain you how you should see it, because a lot of times we will get confused in and carried away by the noise of the news. So first thing you do is filter out the market impact. Only look at the news which have the highest market impact. Uncheck the mid and the low impact, just the highest. So three red dots means the highest impact. And then look at the flag next to it. The most important news should be for US at the moment. So it has come around 6 o'clock. Consumer confidence survey, which if you can see, the expected forecast for that was 116 and it has come 106. Now, most of the times you can also look into these news and what do they represent. Consumer confidence index, as you can see, it represents consumer confidence. And let me show you more information about this. If you see here, consumer confidence basically is released monthly on the last Tuesday of the month. So if you see that today is the last Tuesday of this month, and that is the reason that why consumer confidence data is released. But to give you what actually the consumer confidence data is, and to understand how consumer confidence work, basically we are talking about what is the business condition like. So when I say a consumer confidence data, that means I'm trying to assess that how much confident consumers are in the current businesses, right? What is the attitude of consumers? What have do they have intentions to buy more products? What are their vacation plans? What is their expectation for inflation? uh, Basically the idea is, if I know that how confident a consumer is on spending, I will be able to judge what is the inflation going to be like in the future. So that's why this data is really important. And let me show you today what has happened. So if you see, there is a major fall in the consumer confidence. It was expected to be around 116. It is around 106. Now, what has happened? Because of this major fall, dollar has gone weaker today. And let me show you the impact, what happens. Let me really quick. I'll take you back to our platform where you can actually see what has been the impact of this news today. So the moment consumer confidence news came out, and it shows that consumers are much lower on confidence as we anticipated. News came out somewhere around 6 o'clock, and let me show you the price movement here in gold prices, because when these kind of news comes out, the dollar gets weaker if the news is negative, and because dollar gets weaker, gold prices bounce. So let me show you. The news came out somewhere around, if I'm not wrong, let me just quickly check. It came around 6 p.m. in the evening. Now 6 p.m. in the evening, so I'm going to show you really 1 hour movement, and look at this. This is what you see is 1 hour movement, and let me show you actually much more toward 30 minutes movement. Now let just see how 30 minutes of gold looks like. This is where that news came out. If you see, this is exactly at 6 o'clock. If you just look at this, this is exactly at 6 o'clock. And it came out today when gold was 1920. Now, because the news was weak and dollar became weaker, look what happened to the gold prices in 30 minutes. In 30 minutes, gold jumped from 1921 all the way to 1934 and continues to go up to 1935, and now it is at 1937. And this is a big jump, because from 1921 to 1937 we are already talking about a good 15-16 dollars movement. So anybody who's looking into a 10 or 20 ounce of gold, you're talking about more than $200 profit or loss if you're on the other side of the trade. And if you can see, gold prices were just going down in last few days. If I show you last few days, gold prices have been just falling down. Look at this, just very clear downside right here. Just look at this trend. This has been on the downside, and because of this news today, and last few 4 or 5 days, we have seen gold prices breaking this trend and now moving on the higher side. So this is the impact a lot of times these kind of important news create. So whether it's an inflation data or it's a GDP data, or as today, as I said, consumer confidence, one of the most important data which you can look into. Same thing, if inflation data comes much more higher than anticipated, then the market sentiment is all about that inflation is higher, which means central bank is going to increase the rates, which means dollar is going to get stronger, gold is going to get weaker, and that's how basically the prices would move in the longer period. So economic events definitely impact the prices of the current commodities and stocks, right? I just showed you impact on gold. Let me show you what has happened with stocks also after the same news, because now stocks are moving in a different direction. Why? Because this is a month of earnings, which brings me to the next point, that which is another important economic data which you should definitely look at this. So there are employment indicators, which means most important employment indicator is the non-farm payroll. Once we discuss how the stocks move, I'll also tell you employment indicators is why it is really important, because when central bank is about to increase the interest rates or decrease the interest rates or about to take a decision on interest rates at all, they want to see the employment indicators. They want to see, do people even have enough jobs to absorb the shock which they will receive once we increase the rates? Because once we increase the rates, loans will become expensive. If loans become expensive and I don't have a job and I cannot borrow money because interest rates are too high, that would only create more chaos. So that's why employment indicators are really important. And the most significant news which anybody could see, hear me out, it's non-farm payroll. Non-farm payroll is one of the most important economic data. It tells investors about how many jobs have been generated in the private sector in US, and it excludes the farming industry because a lot of jobs in the farming industry are mostly seasonal. So it does not give the right picture of the employment. That's why it's called non-farm payroll, which means how many jobs have been generated. And this comes every first Friday of the month. So when August is done, September comes in. The first Friday in September, 4:30 p.m. Dubai time, non-farm payroll news comes out. So always and always try to look at this. If the number of jobs generated are higher than anticipated, then dollar gets stronger, gold gets weaker. If the number of jobs generated are lower than anticipated, then dollar gets weaker, gold becomes stronger. And we have seen this happening back in the past. The only thing which you have to understand is these kind of changes may not last for too long because the data changes month on month. But yes, it definitely impacts your investment, definitely impacts your trade as well. Another important thing, which is because I'm currently scrolling down through a lot of questions right now, and some of you have asked that how the stock prices get impacted, because stocks are individual companies. I mean, how Microsoft or Nvidia or Amazon will get impacted by looking at the consumer confidence? Absolutely, there is not much impact on the individual stocks, but I'll tell you what will impact the stocks more, and that is the earnings announcement. Earnings announcement is one of those things which can actually push stock prices higher or lower by a very significant percentage. Now, great part is I'm going to explain it to you, and I'm going to show you the impact of a good earnings, how it actually impacts a stock. First of all, what is the earnings and what we have to look into the earnings? The most important part we have to see, how do you interpret the earnings season? The most important part of the earnings. So first of all, every company which is listed in stock market is supposed to disclose their earnings every 3 months. I'm talking about the likes of Apples and Amazons and Facebook, Coca-Cola, MasterCard, Visa, any big company you have purchased shares of. They are obligated to show their performance, and this performance is shown every 3 months. Right now, when I say every 3 months, it starts with April, the end of first quarter, which is March. So April is the time when the companies will disclose their earnings, followed by April, May, June, then July is the month, then July, August, September, then October is the month, and then October, November, December, January is the month. So December, Jan, April, May, July, August, and then October, November, these are the times when all of these companies, the most of these big giant companies and medium companies and smaller companies, they come up with their earnings season. Now, what they talk about earnings, they talk about how much money they have made, which means how much revenue has been generated. And obviously, if there is a performance, that performance need to be compared or it needs to be evaluated. And who evaluates it? The Wall Street analyst. They have their set of estimates. They compare the actual performance with their estimates. And if that performance beat the estimates, the stock moves higher. If it does not, then the stock moves lower. Three things which you definitely should see in the earnings season is when the earning transcript comes out, you have to see whether the earning per share has increased as per the previous quarter or not. So if in comparison to previous quarter, if the earning per share has increased and it has beat the Wall Street estimates. So if I'm a Wall Street analyst and I expected that the Facebook will have an earning per share of $1.5, and if the earnings comes out 1.7, then Facebook beat my estimates, which means the stock will push, it's expected to push higher. So this is one. Somebody just asked, can you explain about earning per share? Definitely. So as the name suggests, earning per share, whatever the income a company generates, they have to give some dividends to the investors. So the income which is left after the dividends, you divide that income by the number of shares a company has issued. So how much per share a company has earned. Now, to make it much more simpler, if you have invested $10 in a company, how your $10 have been utilized, how every single penny which has been invested in this company has been utilized. So if earning per share of a company increases and beat the Wall Street estimates, that means that your money has been used efficiently. That means that the company is doing well. Higher a company's earning per share, more profitable it is considered. So always remember this. A higher earning per share quarter on quarter means company is much more profitable. And you can find this information, even if you Google it, you can find this information, because these are companies which are already public. So they have put their results out on the internet. You can always find it out. or talk to our consultants. They will definitely provide you a perfect research and a perfect idea about this, right? Now, this is one thing which you see, earning per share. Second, what you see, revenue. How much revenue company has generated. If that revenue is more than what Wall Street expected, brilliant, the stock could go higher. If it is less, stock could go down. And the third and by far the most important thing is the future outlook. Let me tell you guys, there have been times, instances I have seen in last 10, 11 years, a lot of times companies come up with really good earnings, brilliant revenue outlook, brilliant revenue numbers. But the future outlook, the moment the future outlook becomes gloomy, the stock price stop. So to give you an example, Apple had an history of coming up with great earnings every single time. They were beating the earning per share, they were beating the revenue estimates, and they were doing really good. In 2014 or 15, there was a certain shortage of iPhones, and they were not able to produce or sell iPhones. And they anticipated that because we are not able to sell too many iPhones, our next quarter may not show enough profit. So the moment Wall Street saw this news, Apple stock fell almost 10% on that day. Their earning per share was very good, the revenue beaten up the outlook, but their future quarter outlook was lower than anticipated, and the stock fell down by 10%. So you always have to see when earnings comes out, it always comes out with what is the forecast and what's the actual. If actual is more than the forecast, both revenues and earning per share, that's a good news. The stock is expected to go higher. Now, let me give you a really good audio visual of what I just said. Let me show you a quick example how important the earnings can be. I'm going to show you a stock called Nvidia, and Nvidia is a graphic chips manufacturing company. So basically, if you feel that artificial intelligence and robotics are going to be the future, there will be a lot more efficiency needed in the high efficient environment, and those efficiencies are achieved when high efficient graphic chips are being fitted into these systems. Who manufactures these chips? Nvidia is one of the biggest companies which does that. Let me show you. The current stock price is $487 per share. The stock is up even 4% today. But let me show you on the day when Nvidia disclosed their earnings. If you can see right here, this was the end of the closing on 24th May when the price closed at $300 per share. After the closing of the stock market, the earnings came out and they had stellar earnings result. This was in May, June. The earnings came out really good. They beaten up the Wall Street estimates. The outlook for AI and robotics also became very popular. And next day, Nvidia, which closed at $305 per share, next day it opened at a gap. Look at this gap. Next day it opened all the way to $385. From 305 to the closing, $385. $80 increase in one night just because they had declared good earnings. And since that day, from 385, it has gone all the way highest to 501. And this was the earnings in June. Of lately, the earnings which they came out with, which was right here when the stock was 432. They came up with good earnings. Next day, the stock was 459 and then went up to $500. Currently, it is around 486. So, does anyone knows about Nvidia or the movement I just talked about? In one day, $80 increase only because of the earnings. Has anybody invested in Nvidia? Let me conduct a really quick poll to see, or let's do one thing. Just okay, a lot of you already started replying, so no poll needed on that. No. Yes, before the earnings. Okay, great. So there is one gentleman who just said that I invested before the earnings. So I hope you have seen decent results there. Okay, okay. Okay, so a question that when is the next earnings for Nvidia? Good question. One earnings just happened, so now you have to wait for another 3 months before this happens. But please understand, not necessary that every quarter is the same. So that's why it's important to talk to your risk experts. Just see, understand that how the earnings actually impact and how the quarter has been for that particular company. Okay, one more answer I got. Yes, before the earnings. So that's perfect, right? If you have invested before the earnings, then I'm sure a lot of you must have booked your profits. If you're still holding on to the stock, I think the stock is still up today. The chances are pretty high for Nvidia to do really well, because AI and robotics is something which is continuing to go higher and higher. Also, something which we prepared using these fundamentals, and let me show you, this is something which is called price action analysis, and I'm very eager to share this with you because this is one of a popular strategy you can also use, because now you know that which fundamentals really impact the stocks. Let me show you how normally we take advantage of this, and this is something which a lot of you can actually do. To find out this data is not that easy, but then again, that's why you need your consultants with you, and they can really do this for you. And this is called price action analysis. Now, this is just an example of what we created. I'm just going to zoom it a bit to show you. Okay. Now, this was created somewhere around for the earnings which came out between 21st to 25th August. If you can see this price action analysis, to again, for a very layman understanding, what we have done is we check which quarter earnings are this. There is Q1, there is Q2, there is Q3, there is Q4, 4 quarters. And then we see that which company is coming up with which quarter. So let's say we have taken an example of Nvidia over here. Luckily, the flyer which I have also we did for Nvidia. So let me just show you this right here. This is Nvidia. So the first column for Nvidia, this was last price. Look at the Bloomberg target price, the very next column for Nvidia, which was 522. It almost reached 500, but this was, and the earnings were supposed to come on 23rd August after market. And look at this. So this is something which we did. This column talks about the probability of an earnings beat, the probability that the company is going to beat the Wall Street estimates. And for Nvidia, that probability, if you can see, was around 65%. If I'm not wrong, this is Nvidia right here. And see, the probability for Nvidia to beat that earnings were around 65%, right? And also, there is something called a 1 day implied move. Implied move means any move which is a event specific move is called implied move. This is again calculated, and we saw for Nvidia that in 1 day, if there is a earning surprise, it could move around 10%, right? And also what we did a historical analysis that if maximum, for example, if you buy Nvidia on the day of earnings and close it on the same day, then what is the average return you could get into the stock? Now, in case of Nvidia, that was somewhere around. So let's focus on these columns. Absolute earnings announcement. So absolute percentage movement in Nvidia, which we could see, would be around here. See, somewhere around 17%, which is the absolute movement after the earnings. And if you hold on to the stock till 7 days after the earnings, right here. So this is T plus 7, which is if you buy the stock, hold on to it for 7 days after the earnings, the average movement in Nvidia would be somewhere around this. Let me reduce it a bit more. Yeah, right here, somewhere around right here, 11%. So if you hold on to the stock on the day of earnings and then close it by the end of the day, the return could be 7%. If you hold on to the stock 7 days after the earnings, your return could be around 11%. And if you hold on to the stock on the day of before the earnings and hold on to it for until 30 days, on an average, you could end up making 17%. Now, how did we arrive on that number? We started finding out the movement after the earnings in last 10 years of the same quarter. Now, that is not an easy data to find, but this is just to show you that how much in-depth analysis you can actually do stock over stock. All you have to do is find out last 10 years of pattern. Now this is a lot more technical than fundamental, but some of you asked that how can we use technicals with fundamentals. See, if you're looking at a chart and thinking about news, that's not going to work. The only way you can combine technical and fundamentals and try to come up with a new strategy is like this: you take a fundamental event and you do a historical technical research on it and try to find a pattern, like how we found it in Nvidia, that on an average the probability that Nvidia will beat the earnings estimate is around 65%. Now 65% is a good enough number for me to take a trade, but it is much better than me speculating on Nvidia and not knowing anything about it. So that is the difference. While fundamental analysis tells us a lot more about the company's revenue and earnings and what is expected and how they have performed, technical analysis mostly tells us a pattern which has happened before. So there can be a combination. Obviously, this is something which is very unconventional, but then these are different times. We are living in a world which is a very post COVID world. The world has been divided now. It was before COVID, which was BC, and then after COVID, which is AC. So now post COVID, we are living in a very different sort of a market. People have started getting used to the idea that any time market falls down, it recovers in a V shape format, like how it did in 2020. That's what made people buy a lot more in 2021 and 2022, but it did not work in the similar manner, and it took a lot of time for the tech to recover. They are still recovering. So we have to be very careful, and we have to understand that how we can take advantage of fundamentals. Just before I leave, I'm going to leave you with something which is really, really intriguing. I'm sure many of you have heard about Warren Buffett and his ideology of investing into value stocks. And value stocks is nothing else but a clear fundamental analysis where you find out the intrinsic value by using discounted cash flow methods, and you see whether a stock is undervalued or overvalued. This is as fundamental as you can go. And let me share a portfolio with you which our research guys prepared. And the ideology behind that was actually Warren Buffett. But let me show you, and you can actually get an access to this portfolio. So anybody who has joined the webinar today has a free of cost access to this portfolio. Obviously, you can, if you want, you can click pictures, or you can just call your RMs right away after the session ends and tell them that I want the portfolio which was shared on the webinar, and you will receive it over your email. And this is something which we did for a lot of our clients, and we call it a value investment portfolio, and basically call it the Warren Buffett way of doing it. And I'm sure a lot of you know who Warren Buffett is. And for those investors who basically like to buy for long term and hold on to the stocks, these were the few names which we came up with. Again, as I said, please don't take it as a recommendation. It's more of a information. And if you are interested in any of these companies, please talk to your risk experts, look at your risk appetites, and only then invest. So just to give you an idea, how the Buffett's investment strategy used to work: assessment of the intrinsic value. So how Warren Buffett normally does, he examines the intrinsic value of a company. The intrinsic value means the lowest a stock price could go. And this is calculated by a reverse cash flow method. And it shows that how much potential a company has for growing. So it tells you whether a business is how undervalued or overvalued it is. And then whether there is a competitive edge to that business. Take examples of Talabas or Zomatos or Ubers and Lyfts, when they came, they had a very significant competitive edge, right? And who are the rivals? What are they doing? So, economic moat and competitive edge, long term holding. Like Warren Buffett always believes in holding quality investments for a longer period of time. So, as they call it, referring to a favorite holding period as forever. He always like to buy stocks and he avoids frequent trading, he avoids short term speculation, right? So that's why and it really Warren Buffett do a very significant emphasis on leadership. If he believes that the leadership of the company is strong and it creates a value and it's trustworthy, very investment oriented or investor oriented, he would go for that stock, right? And again, as I said, this is longer term portfolio, minimum period of 6 to 7 years. We tell you to look into these companies, look at these stocks, and these are the names which you have heard. I'm talking the likes of Coca-Cola, American Express, Johnson and Johnson, Bank of America, Globe Life. And if you see, Globe Life is somewhere around the current market price that time was $112. Visa, General Motors, Apple, BYD. BYD, please understand BYD. It's called Build Your Dreams. It's an electric vehicle company, and it's one of the best. China's largest manufacturing electric vehicle company, and China itself is the largest electric vehicle sector. So BYD in Warren Buffett's portfolio, it's a big thing, and the stock just values around $30-$35. I think whenever this portfolio was made, let me just check the date real quick if I could see this. Okay, not here, but I think maybe at the end of the portfolio I'll be able to see. So this is one portfolio, and again, you don't just put all your savings at once. If you feel that the stock is overvalued, you can buy 25%. You can use 25% of your money and enter now. And when the stock drops, you enter again. And when the stock drops further, you enter again. Because these are value stocks and not a lot of them are growth or tech companies, the fall in the stock price will be at a very slower pace. Like for Coca-Cola, to come down from 61 to 54 and then 54 to 49, it could take time. So that's why you invest into 3 phases. So as you can see, this was as of 1st August. So if I have to pick a stock, let's say for example Coca-Cola for that matter, 1st August it was $61. And if I see let's say for example currently where Coca-Cola is, let me just show you right there. So Coca-Cola 1st August as the current market price, as you can see, it was somewhere around 60 or $60, 60, 60.5 or $61. Now let me show you the live price of this, and today is 28th August or 27th August, and if you see this on the live platform, the current price of Coca-Cola 60.5. In 27, 28 days, if we see the last movement in the entire August, Coca-Cola, so let me show you right here. And this is something which you can see very easily in any of the trading platforms. In August, it has gone. So this is the month of August, 30, no, May, June, July, and August right here. It was around 63 and it has come down to 62, and 61 is when we started this portfolio, and currently it is around 60.5 or 60.8. But if you see in last 1 year, Coca-Cola has been around 64, which was in April, and the lowest it has seen is around 58. So 64 to 58 right here, and it continues to move in a similar range. If you see, look at this range right here before the big fall. If you see this, see this range for Coca-Cola right here, somewhere around. So these kind of companies, they always work, they always move on a significant pattern, and the best part about Coca-Cola is it gives you a dividend. So it gives you a dividend, it gives you a fixed income, and that's the most important part about it. So whenever we are looking at these kind of portfolios, we should always remember that there is a value added to it. That's why we are calling it as value investment portfolios. Look at American Express or Johnson and Johnson, and there is a detailed explanation given that why these companies during the second quarter 2023, Coke delivered impressive financial results. Momentum is dynamic business landscape. Net revenues have grown by 6%. EPS is up by 34%, and $4.6 billion of revenue year till date to date. The beverage market global revenue is projected to experience a substantial growth in 2023, and it's going to be going even better. And the rivalry between Coke and Pepsi, which is also called Cola Wars, has been a long-standing battle for market share in the soft drink. And Coca-Cola has a very distinguished marketing strategy, and that is something which goes. It has that reputation, and as I said, it's called the dividend king. As you can see, it's mentioned over here that it is a dividend king as it continues to deliver dividends, consistent payment of dividends since 1964, and it has continued to increase the dividends for 62 years. So the current dividend yield is around 2.9%, and if you hold one share of Coca-Cola for 1 year, you will get $1.84 as a dividend for 1 year. So if you have 1,000 shares, you receive almost 1.8 or $2 worth of dividend if you hold on to it, and the stock doesn't move that much. So fundamental analysis helps you to do a lot of long-term investments, and this is something which you can always do. I think there are a few questions which I would like to answer since we have reached to the end of this session. Um, can we get the copy of these portfolios? Yeah, as I said, definitely if you have attended the session, please talk to your RMs. You will definitely get the copy of these portfolios. Second, can we get the demo account on the platform? Yes, you can. You can also trade. You can also, so basically, a lot of my clients, they would replicate these portfolios for 5-6 days and see that how they can actually execute the trades. Demo accounts are really good to practice, and you can also monitor the prices real quick, like how I showed you the movement in the prices, right? So that is also something which you can do. So yes, you can get your demo accounts. Please talk to your RMs. And also somebody asked if we can do these sessions one on one. See, if you need a more detailed explanation and you want to sit with me for the portfolio, I'm more than happy. I'm available. Please book your slots just a day before, and so I'll schedule my day accordingly. Talk to your RMs, and they will definitely provide a slot for you. Please come to our office. We have a facility at Emar Square. You can come sit in our office, and we can explain it to you step by step how to proceed. Uh, just last question I'll be answering here. What do you think about stocks? See, as of now, and it's a very important question because I'm glad somebody asked this, because a lot of clients have these questions now. Where is what's next now? So we have a lot of clients who are currently investing in bonds because bonds are giving 5% yield, and in last 10 years, bonds was never a favorite, but now it has become. And obviously, so a lot of clients are investing in bonds, and a lot of clients are investing into quality stocks. So this is the year of investing in quality, the companies which are able to pass on the rising cost of raw materials to the consumers. That's really important because inflation, if continues to increases and if it doesn't stop, then only those companies will make sense to invest in, which can absorb inflation. And how you can absorb inflation? Well, you pass on the rising cost to the consumers. So there are such companies, and we can actually filter those companies for you who can absorb the inflation, and those are the quality names you should be investing in. So bonds is one. Of course, US government bonds, and there are some corporate bonds in US also which gives you really good yields, and you can invest into that. But obviously, as I said, please talk to your risk experts. It depends on your risk appetite, how aggressive or conservative you want to take your chances on. I feel 2023 should not be any different than 2022 when it comes to investment style. There's a big difference. In 2022, inflation was 9%. In 2023, inflation is 4%. It is expected to go down much more by the end of 2023. So now a lot of tech companies which were falling down in 2022 have started recovering. Nasdaq has gone up by 33%. Amazon, Tesla, Microsoft, all these stocks have started going higher. Nvidia is one of those companies. So I think pick out some quality names from tech, but your major weightage should be given to those companies which gives you a fixed dividend and low volatility. So low volatility, fixed dividend, good quality, less leveraged. And of course, if you're doing day trades, please put your stop losses. Somebody talked about that I want to invest in gold, but I don't want to invest directly into the commodity. That's a good approach. If you feel that gold prices are going to go up, you can invest into some gold mining companies or gold funds. I think that is a lot of my clients, they're doing in a much safer way when it comes to taking exposure in a commodity, right? So once again, guys, I think we have a few more questions, but I think I'll be able to answer this. Any other questions, please? I'll be able to reach you out one-on-one personally, and you have your emails already registered, so we can definitely reach you out. Or please reach out to us. We are located in Imar Square. We are working 10 a.m. to 10 p.m. So anytime which suits you, please let us know, and we'll definitely meet you, connect with you, and definitely assist you with any of your investment requirements. We are doing a lot of arbitrage based strategies also, but then again the risk changes, the risk appetite changes, and we need to explain this to you much more in a detailed way, so that you can carefully understand the risk and reward perspective in this, right? So thank you so much, guys, for connecting today on this session. Somebody just asked when is going to be the next webinar. We do this every week on different topics. Like last time we did on psychology of trading. We talked about how different investor behaviors impact your investment decisions. Today we did on economic understanding and earnings, and fundamentals versus technicals. We took some live examples of how news impacts the prices of commodities and stocks. Also, in the past, we have done sessions on pair trading strategies and some investment ideas and a lot of trading strategies. So again, over a period of the month, we'll continue to do these sessions. And if you like this session, please go on Google reviews, Century Financial, give us your ratings. It only encourages and motivates us to do better. And whatever your feedback is, please write it down and talk to us, meet us. We'll be more than happy to assist you. And any sort of opinion or consultant you want regarding the markets, we are there to provide it to you. That's what Century Financial does. So once again, thank you so much. We'll see you next week with a different topic. And before that, if you have any questions, come to us, meet us, and definitely we'll help you out. So continue, invest safe, and do not take any higher leverages. Please put your stop losses and maintain a trading journal, and do a lot of practice on demo accounts. Thank you so much. We'll see you next week, same time, on a different day probably, but definitely we'll see you next week. Thank you so much. You have a good night.